So what moves the oil price? What do you have to watch out for? And I'd like to get into this is the nitty-gritty of, well, what we're interested in here. The price of oil, like most other freely traded products, is set by supply and demand, of course. It's supposedly very simple. More buyers than sellers, the price goes up. More sellers than buyers, the price goes down. That's the basis of all markets, isn't it? Okay, but why are people buying or selling? That's a bit more complicated. The supply of oil is, of course, determined by how much oil can be pumped at any given time. The factors that determine demand on the other hand, extend far beyond just how many people are driving to work every day. So we're going to look at supply first. Now, until recently, supply of oil was pretty steady in the short term. It takes a long time to find and to develop an oil field. Once the oil wells were pumping, usually a producer preferred to pump all the oil that they could because they've spent a lot of money to find the oil, drill the well, blah, 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 and it costs money to turn it off too. So until recently, the majority of short-term changes in output were disruptions that caused a reduction in supply. It's very hard to have a sudden increase in supply, but you could have a sudden decrease in supply. Now, what are these disruptions? Well, loading terminals break down, power outages, slow production, thieves damage pipelines, bad weather shuts down offshore oil rigs, terrorists attack oil wells and pipelines. Iran was shut out of the global oil markets for years because of sanctions. Libya's oil production, they had a civil war there. And sometimes producers just shut down their operations for maintenance. Also, oil fields get exhausted over time. For example, they pump the oil out and eventually there's no oil left. Britain's North Sea oil fields, for example, made the country a net exporter in the 1980s, but now Britain's a net importer of oil. So reductions in supply naturally tend to push up the price. Okay, so that's what could cause a sudden reduction in supply. What could cause a sudden increase in supply? Historically, that came from only a few places. First off, of course, when the obstacles or disruptions that cause a decrease in supply end, supply naturally would come back to the old levels, and so you'd get a sudden increase. That's the easiest thing. For example, oil prices went down recently because there were fires in Canada that shut down Canadian production, and some people were attacking the pipelines in Nigeria. But the Canadian fires are out, and so Canada is back online, and they've managed to deal with the terrorist problem in Nigeria. So Nigeria is pumping more oil. But there's also another way that supply could increase, and this is very crucial. Some countries, in particular Saudi Arabia, kept some supply capacity in reserve. Saudi Arabia did this in order to retain its role as what's called the swing producer within OPEC, the Organization of the Petroleum Exporting Countries. And in fact, it was the swing producer within the world oil market. That is, so what's a swing producer? When demand increased and prices rose, Saudi Arabia had some spare capacity that it wasn't using, some oil wells that were ready to pump but weren't pumping. And it would raise its production in order to bring supply and demand back into balance and keep prices from rising too far. On the other hand, when demand weakened and prices fell, the very rich Saudi kingdom would reduce its output to shore up prices, to keep them from pricing falling too low. The reason was that Saudi Arabia, with its huge reserves of oil, wanted to keep oil prices low enough that the global economy would remain healthy, and so that it wasn't economic to produce alternative sources of energy. But it also wanted to keep prices high enough to maximize revenues over the long term. This was the historic way that the oil market ran until about 2008, 2009. However, fracking and horizontal drilling changed everything. The oil world has changed very much because of the development of hydraulic fracturing or fracking and horizontal drilling. Fracking is a technique where the drillers inject liquids into the oil wells at high pressure, This fractures the rocks and releases the oil and natural gas. Actually, fracking isn't that new, but it just wasn't widely used before. However, it came into fashion recently with new technology that enabled operators to drill wells horizontally. And this has enabled producers to access oil that they never could have accessed before. So looking at these pictures on the web, as you can see on the left, a typical vertical well will intersect the oil deposit over really only a very small part of its length. So not that much oil, or the rate at which the oil seeps into the well isn't that great. But a horizontal well has much more oil, much more surface exposed to the oil deposit, and so it produces a lot more oil, although as a result, it will also exhaust the oil deposit more quickly. Now, the picture on the right shows how much more you will get if you fracture the rocks. So even in that case, even more oil flows into the well. You get more oil out of there more quickly, but of course you exhaust the well even faster. The result of this has just been stunning. It's boosted U.S. and Canadian oil production by about 80% over the last few years, from 8 million barrels a day to 15 million barrels a day. And it's turned North America into the world's largest oil producer. North America, US and Canada produce about 40% as much as all the OPEC countries combined. So this has eroded the power of OPEC and Saudi Arabia to control the supply of oil and therefore control the price of oil. I'd like to add that just from a personal point of view, it's also created a nightmare for a lot of US residents. Fracking causes earthquakes, and it occasionally forces natural gas into the water supply. And you get people get these flames shooting out from their water faucets. It's but that's a different story. Now, fracking is qualitatively different from previous methods of drilling for oil, and it's really changed the nature of the oil industry. Previous methods of oil producing were very heavily capital intensive. It took a long time and a lot of money to develop an oil well. Fracking wells, on the other hand, are a lot cheaper. They're faster and they're easier to turn on and off. They've turned oil production into almost an assembly line process, and there's been a really great increase in the efficiency of producing oil now. This has changed the elasticity of supply for oil. Traditionally, as I said, it took a lot of money to start an oil well, and so the producers didn't want to turn them off even if the price fell, since the marginal cost of pumping the oil once you developed it was relatively low. Fracked wells, on the other hand, are cheaper to start, but apparently they cost more to maintain, so their owners are more willing to turn them off when prices fall. So the supply of oil now reacts much more quickly to the demand than it used to. In addition, this is an unusual point, fracking and horizontal drilling has given rise to a large number of drilled uncompleted wells. These are DUC wells, D-U-C wells. These are wells that have been started. They've started drilling them, but they haven't completed them. They can be brought onto production within 4 or 5 months if the drilling well company believes it would be economical to do so. So right now, from what I gather, there are something like 4,000 of these DUC wells in the US. So they represent a potential 1 million barrels a day of oil production that in theory could be brought onto stream relatively quickly. Of course, quite theoretical, as they couldn't all be, there just aren't the people and equipment to start all of them at the same time. But what it means is when the price goes up, the supply responds much more quickly than it used to in the past. Now, market participants monitor the supply of DUC wells, which is called the frac log, the fracking plus backlog, to anticipate possible near-term increases in output when the price starts to go up. So the increase in supply from fracking in the US is one of the major factors that has pushed oil prices down, especially over the last year or so. Fracking changed the nature of the oil market in another important way by making oil production sensitive to the financial cycle. The big oil companies really are independent of the banks. They finance everything out of their cash flow. But now you've got a lot of these small companies that need bank loans in order to operate. So the supply of oil, at least in the US, has become responsive to credit conditions, an entirely new development for the oil market. So that's why earlier in the year, when it looked like a lot of banks in America were pulling back loans from oil companies, it was very negative for the future supply of oil. The price goes up, though, the companies become more creditworthy, the banks lend them the money, and supply increases. Now, perhaps most importantly, this increase in supply in the US, which is not a member of OPEC, has eroded or even destroyed the importance of OPEC in stabilizing the market. It's increased the amount of oil that non-OPEC producers and made the US, not Saudi Arabia, act as the world's swing producer.